Good day everybody. Please remember to subscribe to my channel and to like this video. We're gonna have a look today at some of the more technical aspects, and we obviously know about the changes at Ethereum. So we will address all of these aspects. Thank you and enjoy this video. So let's have a look at cryptocurrencies. First of all, what is a cryptocurrency? It has a digital currency in which transactions are verified and records maintained by a decentralized system. Cryptocurrencies make use of cryptography rather than a centralized authority, and as an alternative form of payment using encryption algorithms. Let's take a look at two major cryptocurrencies today. One is Bitcoin and another one is Ethereum. So the release date for Bitcoin was 9 January 28. Ethereum 30 July 2015. Let's take a look at the total coin supply. So from the beginning, Bitcoin indicated that they will only mine 21 million Bitcoins, and originally Ethereum said it will be unlimited. Let's move over to the blockchain mechanisms. Bitcoin makes use of proof of work, and Ethereum used to make use of proof of work, but since the merge took place, they move over to proof of stake. And we will also address proof of work and proof of stake. Okay, next we move to usage. So Bitcoin is a currency. Ethereum, smart contracts, and it's a cryptocurrency. Scalability, Ethereum, yes, it is scalable. Bitcoin is not scalable. Let's look at mining. So Ethereum used to be proof of work, and they used to make use of GPU mining or graphic processing unit mining, and Bitcoin make use of ASIC machines. Okay, what's the currency for both of these coins? Bitcoin make use of Bitcoin as currency, and Ethereum make use of Ether. Okay, let's look at the block time. Bitcoin is about 10 minutes, and Ethereum between 13 and 14 seconds. Let's look at Defi and Cefi. These are also terms that we hear a lot about when we talk about cryptocurrencies. So first of all, what is Cefi? Well, Cefi, we look at traditional financial institutions and banks, for instance. So in a Cefi setup, all trading is done via central exchange. So you don't own a private key, or in other words, access to a wallet. Cefi decides which coins they list and trade. They also impose their own transaction fees. So trading cryptocurrencies in a centralized fashion, you basically don't own your cryptocurrency when you buy or sell it, and you are subject to the rules of the structure. It's also more vulnerable to security threats. What are the advantages of Cefi? Trading and borrowing and the fiat to crypto exchange or conversion. One can easily assume that all cryptocurrencies are decentralized, but in actuality, most of them are, but not all of them. We know Algorand, Coinbase, and Tether. These are all examples of cryptocurrencies making use of a centralized exchange setup. Let's have a look at DeFi. So no exchange is involved. This is an automated process created by applications and is developed on top of the blockchain. This creates fair and transparent financial system, and anybody can participate. What the system offers is borrowing, crypto lending, yield farming, and asset storage. Some of the biggest players of a decentralized financial setup is Bitcoin and Ethereum. Other examples of cryptocurrencies making use of DeFi is USD Coin. Let's look at transaction processing. Bitcoin verifies one transaction every 10 minutes, while Ethereum can validate between 13 and 14 transactions per second, but that's on a much smaller scale in comparison to a company like Visa that can verify transactions or process transactions at a rate of about 2,000 per second. So in order for Ethereum to become competitive, they will need to make use of other mechanisms or get help from different layers of decentralized applications. The Bitcoin lifecycle. In the first place, the sender creates a transaction. Then the sender's Bitcoin wallet validates the specific transaction. The transaction is then sent to the mempool. Miners get the transaction from the mempool and start mining using a specific consensus algorithm. After the block is fully minted, it's added to the network. The chain validates the new block, and every peer in the network receives the blockchain with the new block, and the receiver gets the Bitcoin. Now, what is a consensus algorithm? Well, Bitcoin makes use of a proof of work algorithm. So in short, a consensus algorithm is a strategy for getting consensus in a blockchain network. What is the purpose of a consensus algorithm? Well, that's a way to achieve democratization of the network. So Bitcoin consensus algorithm is proof of work. So you get different type of consensus algorithms, proof of work, and that's where we make use of miners. The consensus algorithm is a strategy for getting consensus in a blockchain network. The mempool is just short for memory pool, and that's where the transaction lies until the miner is ready to get it and start mining it. Okay, now what is a miner in this concept? Well, there's a very close correlation between the typical or traditional miner in a mine, there's a coal mine, and a miner in a digital world. There's a very strong correlation between a traditional miner and a miner in the crypto arena. In both cases, they make use of specific machinery in order to mint or to mine or to get to the specific material that they're looking for. And that's exactly the same thing that happens here with the crypto or with proof of work. So a crypto miner makes use of, they call it a specific rig, a mining rig. It's not the same as the traditional setup, obviously. In this case, the crypto or the mining rig for a crypto miner is a computer. Now, there are different types of mining rigs. It depends on the type of work and the type of strategy followed. Well, it's important to first point out that crypto mining is only used for proof of work. So this is a process by which new cryptocurrencies, well, let's say it's Bitcoin, then we'll say the process in which a new Bitcoin is being added to the money supply, and miners provide necessary processing power to the Bitcoin network in exchange for the opportunity of a reward. So miners validate new transactions and record them on the global ledger. A new block containing the transactions occur since the last block is mined. So in other words, transactions become part of a block and the block becomes part of the blockchain. And this occurs once the block is considered to be confirmed. So when it comes to mining, there are two types of rewards. One, the new coins being created with each block, and the transaction fee from all the transactions included in the block. So basically, you get a reward for the transaction, and if you're the first one to complete the block, you'll also be rewarded, well, if we talk about bitcoins, you'll be rewarded with 6.25 bitcoins. Ethereum's price dropped about 7% in bitcoins since the merge. Something that's very interesting, when we look at the following cryptocurrencies, Polygon, Arbitrum, Optimism, these are all Ethereum Layer 2 solutions. So in other words, they are built on top of the Ethereum blockchain. And they provide additional services and processing capabilities to Ethereum, and they can also be used if Ethereum would like to increase their transaction verification process. If they want to validate or process more transactions per second, they can always try to incorporate it with these cryptocurrencies. So let's talk about layer 1 and layer 2. What is layer 2? Well, these are protocols designed to facilitate the creation of a smart contract, and in this case of Ethereum, that's built on top of Ethereum's main chain, which is also the first layer. So in other words, layer 2 is built on layer 1, which is the Ethereum blockchain. Layer 2 applications take transactions off the main chain, or they offload it on layer 2, and after processing is completed, they will post the transaction data back to layer 1, and the great advantage of this is scalability, and they try to maintain at least the same level of security. So yes, the main advantages of layer 2 applications, the first one is scalability. In other words, you can process more transactions per second, and in theory make use of the same level of security. So layer 1 security is obviously the best, and if layer 2 applications make use of the same security protocols of layer 1, then one can assume that they will make use of the same level of security. Smart contracts. So we hear a lot about smart contracts, but what is a smart contract? It's actually very simple. Okay, so smart contracts are programs on the blockchain. They are activated or they run when predetermined conditions are met. So we can look at this as a if, when, then setup. If this happens, or when this happens, then the next thing will happen. So it's written into code on the blockchain. So for example, when you want to release funds or send notifications or issue a ticket, we'll make use of these smart contracts. And the advantages of using a smart contract is fast, speedy, efficient, accurate. We can see it's more transparent. It creates trust, security, and all in all cost savings. So yes, we can see the advantages of using a smart contract. Since these are automated processes, it will be much quicker to perform a specific task. You don't have to wait for somebody to do it. It can be more efficient because it is a set of predetermined code. It's more accurate. It creates trust and transparency, since we know that this is an automated process with no human intervention. And obviously this is going hand in hand with better security, a lower risk for security breach, and we can see this all results in a cost saving. Okay, since we are still on layer 2, it's very interesting to see advantages of Ethereum working hand in hand with Polygon. So we can see various type of forks. We see and we know about these so-called hard forks, and that's where we look at Bitcoin Classic, these crypto siblings, one might say, in which there's a breakaway from the main chain where these cryptocurrencies try to remain with the original principles set in place. So for example, there are a lot of talks about a hard fork regarding Ethereum, where a lot of these miners would like to continue mining Ethereum using the same blockchain. And I believe one can look at this as a copy of the blockchain blueprint where a group can still continue. The pros and cons. The positive probably that one can continue as usual. Obviously, this is the creation of a new cryptocurrency, and we therefore can't expect the same reward from a large established cryptocurrency or blockchain, for example Bitcoin or Ethereum, running less. So when we look at layer 2 side chains like Polygon, we can see Polygon can process approximately 65,000 transactions per second, so validation is almost done in real time. Let's look at the most profitable proof of work cryptocurrencies with the best rewards. The Bitcoin reward is approximately 6.25 Bitcoins for successful block. Ethereum's Ether rewards the miner with 3 Ethers as GPU processing. We see also a few other players here. Monero, you get rewarded with about 1.16 of their currency, XMR, also GPU processing. Ravencoin rewards their miners with approximately 5,000 Raven coins, also GPU processing, and Bitcoin Gold rewards the miners with 6.25 Bitcoin Golds, and that's also GPU processing. Bitcoin halving. So I believe a lot of you have heard about the Bitcoin halving process. So we know from the beginning only 21 million Bitcoins were set out to be created or mined. At this stage, 19 million Bitcoins have already been mined. They're basically left with 2 million Bitcoins. So what the halving means is every 4 years, or approximately every 4 years, the payout of the rewards of Bitcoin is being halved. So the first halving was in 2009, and the reward was at that point 50 Bitcoins for validating a block. In 2012 it dropped to 25 Bitcoins, and 2016 to 12.5 Bitcoins, and the current situation in 2020 it went down to 6.25 Bitcoins. The next halving is scheduled for 2024, and the last halving will take place in 2140, and that will be the 64th and the last halving. The halving takes place after every 210,000 blocks. So what's the purpose of this halving? So that's a counteraction against fight inflation by maintaining scarcity. So basically what that means is the price goes up, demand remains the same. That's what scarcity means. We can see that it was really profitable in the beginning when the reward was 50 Bitcoins in comparison to the 6.25. The flippening. What is the flippening? So this is a term that we hear quite often when you talk about cryptocurrencies, especially when you talk about the major players like Ethereum and Bitcoin. So the flippening is a theoretical the scenario when Ethereum will overtake Bitcoin as the dominant leader in the cryptocurrency market. So let's look at the current market cap or the market capitalization. So Bitcoin market cap is approximately $420 billion. So they have about 41% of the total market, while Ethereum is on approximately $200 billion. So let's look at the possibility of this happening. So it's important to keep in mind that the creation of Bitcoin was to fight inflation. So with this move of Ethereum away from the proof of work to proof of stake, you can see a decrease in overheads. This can also lead to a lower inflation rate over time. And since the move is away from proof of work to proof of stake, you can see that's a much greener and less power intensive approach. Another advantage of Ethereum is they have approximately 47 applications running on top of the blockchain, and Bitcoin have none. You see the monthly revenue for Ethereum is approximately 9 times more than Bitcoin's. And Ethereum at this stage has approximately 6 times more active developers than the other cryptocurrencies. And we see the volume of Ethereum transactions processed is approximately 3 to 4 times more than those of Bitcoin. Let's talk about the merge. So for the last couple of years, there were a lot of talk about the merge. A lot of people thought it wouldn't take place. There was obviously a great pushback from the current miners because a lot of people invested in hardware used for mining. It was basically easier to become a miner because if you purchase a machine, you can start mining, whether it is Ether or Bitcoin. So what happened during the merge? The merge changed the consensus protocol for Ethereum. That moved away from proof of work to proof of stake. And as one can imagine, not everybody is happy about this because you need to be invested in Ethereum to become a validator. And you look at about 32 Ether coins, and that's approximately 50,000 US dollars. So that's quite a lot of money. So it was easier and much more affordable to be a miner instead of a validator. But a lot of people is very happy about this, especially if you look at the energy usage. So moving over to proof of stake, Ethereum is going to cut about 99.95% of energy usage. New blocks will also be created in about 12 seconds versus the 13 or 14 seconds. And Ethereum is also putting a cap on the amount of coins issued or tokens issued. So it's moving down from about 5.5 million per year to about 600,000. It's also interesting to point out that the first 1,000 blocks verified on the new proof of stake of Ethereum was basically performed and validated by two players, Lido and Coinbase. It makes up about 40% of the total verification process. So we can clearly see at this stage, only the big players, those with the most Ether, benefits the most from this validation process. But one believes and hope that the market will sort itself out. You can see the bigger players, or those in the possession of the most Ether, gets the most work. That's interesting to point out. Stable coins. What is a stable coin? We know, for instance, Tether, USD Coin, Binance, and TrueUSD are all examples of stable coins. So stable coin is when the value of the crypto is pegged or tied to another currency, commodity, or financial instrument. We see, for instance, that Tether is linked to the US dollar on a one-to-one basis. So for one Tether, you will get one US dollar. So in other words, if you have 100 tokens, you'll actually have $100. This creates some form of security or insurance to the owner of this cryptocurrency. What is an altcoin? Well, in simple terms, this is alternative to Bitcoin. Any cryptocurrency that's not Bitcoin is an altcoin. So for example, Ethereum will be an altcoin. So any coin except Bitcoin is an altcoin. ASIC mining rigs versus GPU mining rigs. Question whether or not you can repurpose your old mining rig if you decide to stop mining. And this is a very good question to ask since the merge took place. So what can you do? Well, in the case of Ethereum, you can probably still use your GPU mining rig, but you probably won't be able to just convert your old GPU mining rig into a workable computer. Yes, you have amazing graphics capabilities, but it might lack some processing power, it might lack some RAM, so temporarily memory, and it's obviously not built for storing a huge amount of data, so you'll have to upgrade the hard drive. So with a few upgrades, you'll probably be able to reuse your GPU mining rig. In the case of ASIC mining, probably not be worth it, since these ASIC machines are exclusively made for the mining of Bitcoin. I would definitely say there's a better possibility of repurposing your GPU machine for computer processing. You'll definitely have to spend some money to upgrade it to a workable computer.